Drawing slanted lines on a 5-minute chart ignores the mechanics of how price actually moves. When you jump into a breakout based on geometry alone, the market often shatters that setup and reverses directly into your stop loss. Charles Dow built a framework based on the psychology of institutional buyers and sellers. His 130-year-old principles provide the structural foundation for reading where smart money is actually moving. Over the next 5 minutes, we will map an institutional-grade trade plan onto a blank screen, establishing exact entry and exit parameters through 5 objective steps. To follow along, you need 3 things: a daily timeframe candlestick chart, a standard volume indicator, and a Fibonacci retracement tool. By the end of this checklist, objective structure will replace emotional reactions. You will have a repeatable process for identifying high-probability setups. Step 1. Define the primary trend. Move your chart away from the 1-hour view and open the daily timeframe. Here, the noise disappears. By identifying consecutive higher highs and higher lows, you establish a clear upward staircase, the hallmark of a bullish trend. This macro staircase entirely dictates your directional bias. While the daily structure is printing higher highs, you only look for long positions. Primary structure acts as your compass. Fighting the macro trend on a smaller timeframe leads to low probability trades and unnecessary losses. Step 2. Identify the phase. Every major trend moves through a specific 3-phase life cycle. Locating the current price within the cycle is a mandatory prerequisite for every trade. Phase 1 is accumulation. Here, institutional money quietly absorbs selling pressure in a flat consolidation. Next is Phase 2, public participation. This is the aggressive high-momentum breakout. Finally, Phase 3, distribution. The chart becomes choppy as smart money sells. This life cycle acts as a primary filter. You only deploy capital during the high-momentum participation phase, avoiding the traps of the distribution top. Step 3. Map the secondary reaction. Chasing a massive Phase 2 impulse usually results in buying the absolute local top. Instead, wait for the inevitable countertrend pullback. We use the Fibonacci retracement tool to measure this reaction. Extend it from the absolute swing low to the peak of the impulse. Dow observed secondary reactions typically retrace 33 to 66%, mapping exactly to this green zone. This reload zone is the specific area where institutions build new positions. Buying here provides a mathematically superior entry compared to chasing the breakout. Step 4. Confirm with context. Before entering the reload zone, you need solid evidence that selling pressure is exhausting. We find that evidence in the volume. In this visualization, price falls into the reload zone, while volume bars in the bottom panel steadily shrink. This combination proves that sellers are losing interest and the primary trend is ready to resume. You also need to distinguish between a temporary spike and a permanent shift. This requires looking at the closing price of the candles rather than the wicks. Look at this comparison. On the left, a long wick pierces the low, but the candle closes back above it. That's an institutional liquidity sweep. On the right, a full-bodied candle closes below the low, indicating a genuine break in structure. Reacting to wicks often traps you in algorithmic fakeouts. True validation depends on where the daily candle closes and how much volume supported the move. Step 5. Execute. With context confirmed, carefully set your entry order inside the validated 33 to 66% reload zone. Your defense is this thick red line. Place your hard stop-loss order strictly below the most recent macro swing low, giving the trade room to breathe without breaking structure. Calculate your position size so that the loss from your entry to the line represents no more than 2% of your total account equity. Once that red line is set, it is locked. Manual overrides are strictly prohibited. This protocol removes the emotional temptation to hold a losing position. Treating risk management as a fixed architecture ensures that one bad trade cannot liquidate your account. This rigorous discipline keeps you in the market long enough for a mathematically proven edge to fully manifest over time. This completed chart shows how 5 steps create a precise architectural blueprint. We have replaced a random mess of candles with clear phases, a measured reload zone, and protected risk levels. You have aligned with the primary trend, identified the participation phase, waited for the reload, and mathematically defined your risk. Open your own chart today. Locate a Phase 2 uptrend on the daily timeframe and map these exact 5 steps to see the reload zone for yourself. A mechanical system only works if you have the mental framework to follow it. To prevent yourself from breaking these rules when the market gets volatile, watch the linked video on building your psychological operating system.